A covered call is one of the most popular option strategies used by investors to generate extra income from stocks they already own. In simple words, it means holding a stock and at the same time selling a call option on that stock. By doing this, the investor collects the premium from selling the option, but also agrees to sell the stock at a fixed price if the option is exercised. The history of the covered call strategy goes back to the origins of modern options markets in the 1970s, when the Chicago Board Options Exchange was founded. Before that, options existed but were traded in less formal ways. Once standardized options became widely available, investors quickly realized that writing calls against existing stock positions was a straightforward way to enhance returns, especially in sideways or moderately rising markets. Let's see how it works with an example. Suppose you own 100 shares of Apple, and the stock is currently trading at $150. You decide to sell, or write, a call option with a strike price of $160 that expires in 1 month. For selling this option, you receive a premium of, say, $3 per share, or $300 in total. What happens now? If Apple stays below $160, the option expires worthless, and you keep both your shares and the $300 premium. If Apple rises above $160, the buyer of the option can exercise it, and you must sell your shares at $160. In that case, you still made a profit because you bought at $150, sold at $160, and also kept the premium, but your upside was capped. This illustrates the trade-off of a covered call. The advantage is that you earn additional income from the premium, which can be especially attractive in flat or slightly bullish markets. The disadvantage is that you give up unlimited upside, because if the stock surges much higher, you are forced to sell at the strike price. In other words, you trade potential future gains for guaranteed income today. Covered calls are often used by conservative investors or income-focused funds. They can make portfolios less volatile because the premium provides a small cushion against declines, though not full protection. For example, if Apple in our case dropped from $150 to $148, you still keep the $3 per share premium, so your effective loss is smaller. However, if the stock falls sharply, the premium does little to protect you. You still suffer most of the downside. A curiosity is that some funds and exchange-traded products specialize entirely in covered call strategies. They are marketed to investors who want steady cash flow, even if it means giving up some upside potential. These products became especially popular in low-interest rate environments, when traditional income sources like bonds paid very little. It is also interesting to note that the covered call is considered one of the simplest option strategies and is often the first that beginners learn, because it combines ownership of stocks with a single options transaction. More complex strategies like spreads or straddles build on the same logic but add additional layers. In conclusion, a covered call is a strategy where an investor holds a stock and sells a call option on it to generate income. It offers extra return in sideways or mildly bullish markets, reduces small losses, but caps upside potential. Simple yet powerful, it remains a cornerstone of options trading for both individual investors and institutional funds. Above, you can find more videos to keep learning about law. Remember to give us a like and subscribe.